the IRA is the culmination of kind of our wish list, if we were to pick one, to put more fuel in the fire for the energy transition. And there are a few other exogenous factors like inflation and increasing structural change, I'd say, in gas markets as well, that have really catalyzed the opportunities around renewables and storage.
Key aspects of the IRA, in our view, in terms of what really might have impact relative to the way we were seeing things before, the extensions of the full PTC and ITC to at least 2032. Couple notes here. First, it's a return to the full PTC and the full ITC as opposed to the step down versions that were previously in place. So they're back to full value, 30% for the ITC, $26 a megawatt hour is the current value for the PTC. And they're extended not just to 2032, but to at least 2032. So it's the later of 2032 or when emissions reach 75% below 2022 levels. Okay, so that means that these ratchets stay in place until we basically reach really high renewable penetration. So it provides a pretty strong guarantee that as fast as clean energy can be built, that's going to be the limiting factor in terms of when these things start to phase out. The IRA also brought in the PTC for solar, so that we think is going to be a really big deal. I'll talk more about that in a bit. The ITC for standalone storage, we've for a long time been saying that we did not expect that to come through. We thought some of the interest, particularly around protecting fossil assets, were going to continue to fight against that, and it was removed at the last minute several times, and finally this time around it did not get removed, and we were surprised when we were not expecting that. But it does change the revenue requirements for storage and pour some fuel on the fire for the markets that were already looking strong. There are also several bonus credits. So there's a 10% bonus credit for meeting domestic content requirements. We think that's going to be a challenge over the near term, but maybe 10 years from now that could get a little more interesting. There's a 10% credit for locating in energy communities. There's a brownfield coal areas, some fossil fuel areas. And there's also a 10% bonus for low-income communities, but that's for projects less than 5 megawatts. What's interesting there, though, is that if you can find a site that's in a low-income community and in an energy community, and you go for a small project that's distribution connected, so you can get kind of an accelerated path through the interconnection process, you could get some very interesting project opportunities. Something to think about. One of the other things that happens particularly with the IRA, is that if there was any question about what the new capacity resource was going to be for anybody that needs new capacity, if there was any question about whether it was maybe still gas, I think that question is gone. So it's going to be very difficult to justify building a new capacity resource. A lot of what we're looking at is what's the capacity value in a marketplace, but when you start looking at the need for new capacity, any utility that needs new capacity, any market that's short on capacity, and you start looking at new versus new, it's hard to see how you come to any resource conclusion that's not storage, particularly under the IRA. We've done some preliminary work on our upcoming forecasts, and there's basically no way that we can see solar not in the money for the next 15 years. Basically, as long as the IRA is in place, it's really difficult to see any condition under which renewables aren't in the money for a long time, short of a collapse in a gas price. The higher gas prices just kind of are a fundamental change, and then the extensions on the ITC and PTC just reinforce it.
For somebody who grew up in the 70s with the oil crisis and wanting this energy transition, I think our time is here.